So once again, Assalamu alaikum everyone, and thank you for joining us today and taking the time out during your evening to join us for this webinar that I hope is of benefit to all of you. We will get started while we wait for some more people to join us. Um, just to give you a quick briefing before we get into it, Irfan and myself are going to present to you with regards to market update. I mean, title's Market Update August 14th, but it's very timely because of the volatility that we have seen in the market recently. A lot of you may have questions that hopefully we may be able to answer. We will go through a couple of things, mainly current market performance to date, monetary policy and how the landscape is changing, why it's important to make sure you're staying the course and how to manage your emotions and your portfolio during periods such as this. We will touch a little bit into the global macro outlook as well and how that impacts your portfolios and the economy in general. And we will then speak a little bit about AI and why that's a hot topic at the moment. Followed by which we will speak a little bit about our portfolio strategy, how we are maneuvering given the current market conditions and what we are doing in order to maximize the potential for our clients' portfolios. We will then leave the floor to questions. So if you do have any, feel free to save them for the end. Otherwise, you could put them in the chat box and we'll try to get to them during the presentation as well. This is just a disclaimer here, just to kind of let you know that nothing here should be construed as investment advice, and it's for educational purposes and just for your own information. So Irfan, he has been recognized as a top Wall Street economist. He has a lot of accolades behind his back, very experienced. He currently serves as a portfolio manager at ShariaPortfolio Canada. Myself, I'm an associate portfolio manager at ShariaPortfolio Canada. I've spent most of my career in the capital markets and the wealth management space, supporting both institutional and retail clients. I actually joined ShariaPortfolio last year from RBC Dominion Securities, where I was managing wealth there as well. So for those of you who don't know, ShariaPortfolio offers professionally managed investment solutions. We're Canada's only licensed PM firm that deals specifically in Sharia-compliant investments, and we are licensed by the OSC as well. We were founded over 2 decades ago in the US, and we have branched out to Canada now. We serve clients globally from all over the world. Our custodian is Fidelity, and all of our clients' assets are protected by the same insurance that is offered at any other wealth management firm, up to $1 million through CIPF. So let's get down to it. Market performance. How has the market done so far this year, and how has the Sharia index done? You'd be pleased to see that despite the pullback we have seen since we hit the all-time highs this year, as of yesterday, the S&P 500 was up almost around 14%. At the same time, the Sharia index year to date was up 15.5%. Now, why is this important? If you actually go and see the 10-year, this is year to date, right? And you see there's a difference of about 1.5%. If you even look at the 10-year spectrum, you will see that the Sharia index is consistently outperforming the S&P 500 by about 1.5%. So it's not just this year, it's not just last year, but consistently over a 10-year period, which is phenomenal for the Sharia index to be able to do that. And we are proud to be able to offer our clients exposure to such portfolios. Now, during our mid-year market update, we had discussed this slide, and it's important to reiterate and emphasize on this once again. Because you may be sitting on cash right now, you may be sitting on funds that are ready to be invested, and you may be asking yourself, well, the market is close to its all-time highs. Should I invest? Should I not invest? One thing which we will get into a little bit further is it's very important to make sure you're not trying to time the market. Now, what this chart is basically showing you is, let's say you do invest at the all-time highs, right? Right at the peak of it, you actually go and invest your funds at that point. Assuming you have a long-term market, horizon with regards to your investments, what's the probability of the market actually being higher the next year following you investing at this all-time high? Well, the probability of it actually being higher within 1 year of you investing at the peak is 73%. And over a 10-year period, now this is where you kind of put it into perspective. You're looking at a long-term horizon. For those of you who have 10, 15, 20 years as a time horizon for your investments, if you invest at a market high today, the probability of you actually being much higher than that 10 years from now is 87%. Now that's massive. To put into perspective, let's say you decided to invest at the peak of the financial crisis in 2008. If you invested at the peak, you would have gone through some drawdowns, some turbulence in your portfolio all the way till today. But today you'd be sitting pretty. Same thing if you invested before the COVID crash in 2020. Right at the peak, if you invested then, you'd still be sitting at a higher investment portfolio value today. So it's important to keep things into perspective. And this data is not just 10-year data that's being used to generate these charts. This is all the way from 1950 to 2024. So it is always in your favor to stay invested and to invest as opposed to trying to wait for the right time to invest. Now, let's talk a little bit about the US and Canadian monetary policy. So, in general, the Canadian economy is weaker relatively to the US, and we've seen the Bank of Canada cutting rates much sooner than the US has or potentially will. Now, one of the reasons for this is the Canadian economy is very sensitive to the household sector and lower productivity levels compared to the US. We're very interest rate sensitive. Now, the Bank of Canada cut its benchmark rate to 4.5%, and they're likely to cut another 50 basis points by the end of 2024. So probably another 2 cuts of 25 basis points each. And this is mainly to be able to support the economy. As of June, the unemployment rate in Canada was at 6.4%. In 2022, it was 5%. So it's very evident that the interest rate increases that we have seen over the past couple of years is making its impact. That's why you are also seeing the unemployment rate increasing. But it's important for the Bank of Canada to be able to support the economy, and by lowering interest rates, they're able to do that. The GDP per capita in Canada has also fallen about 3% over the last 24 months. If you look at the graph on the top left, you will see that GDP has actually been rising, but the GDP per capita in Canada has been falling about 3% in the last 24 months. And this shows how the economy in Canada is a little bit more, don't like to say weaker, but it needs to be treated with a little bit more diligence and care with regards to how the Bank of Canada makes its moves. When you look at the US, inflation has definitely eased, which was the main goal for the Feds in the US. If you look at the top right chart, you can see PCE and core PCE is now just around mid twos, between 2 and 3%. Now, what happened in the past couple of weeks with regards to market turbulence and what you saw, a lot of it was due to the carry trade issue coming out of Japan. And what that was there was a lot of securities held in the US, which was through proceeds from debt that was held in Japan. When interest rates increased, a lot of selling took place in order to cover those debt positions. That's one. Number two, the job numbers did come out in the US and they were a little bit weaker than expected. Now, with interest rates increasing, we've seen in Canada that the unemployment rate has increased. And the same thing is slowly starting to happen in the US. Now, because of that, and a lot of the economic conditions that are surrounding the markets at the moment, the Feds are now likely to cut 100 basis points by the end of 2024. When we started the year, it was a lot more than that. Around mid-year, we were looking at just about 50 basis points, maybe 25, 50 basis points by the end of the year at that point. Now we're looking at about 100 basis points. The Feds are very data dependent, so they're making moves based on data that comes out on a monthly, quarterly basis. If you look at this is the Fed Watch tool. This is showing us that the market is pricing in a probability of 96.5% of the Fed target rate being between 425 to 450 basis points by the last meeting, which is in December. The current rate is between 525 to 550. So this shows you that there's actually 100% probability that the target rate will be, if not 125 basis points lower from here, at least 100 basis points. Now,
Right.
why is all of this information important? Of course, it's important to be aware of what's impacting your portfolio, where the market's going, what conditions are we currently in. But at the same time, it's always important to keep that long-term perspective, because short-term movements in the market will always happen. On a daily basis, what the market is just people buying and people selling. Over the long run, it's really, really important to stay invested. And I'll show you why. If you look at the top left graph, right? This is one data source. From the 10 years ending December 2023, so from 2013 to 2023. Now, this is a 10-year period. If you missed just 10 of the best days in the market over that period of time, your returns would have been over less than half of what it would have been if you were fully invested. So your annualized return would have been 12% if you stayed invested over that entire period of time. Whereas if you missed just 10 of the best days in that 10-year period, your returns would have been 5.5%. If you missed 30 of the best days, you're negative. And more than that, you're further negative. Now, this is just a 10-year period. Now, let's look at the graph on, let's go with the bottom right side. That's 10 years ending 2019. So this is before the COVID crash. The same thing shows the same exact data, same exact conclusion is shown in this. If you stayed invested, 6.9%. If you missed the 10 best trading days, 3.8%. Now, what's important to note is the first graph that I actually showed you was the S&P 500. The bottom right is actually the TSX. So two different markets, but the exact same conclusion. You stayed invested versus not staying invested for just 10 days, 10 of the best days, your returns cut in half. If you look at the graph on the top right, the same thing is shown. Fully invested versus missing the 10 best days, 54% less. The bottom left shows you an even longer period. This is from 1980 all the way to 2024. That is a 44-year period. If you stayed fully invested, if you started with $100, if you stayed fully invested, you'd be at $4,000. If within that 40-year period you missed 10 days, you're at $1,900. It's a huge difference and a very small amount of days that you miss in the market. And the other shocking thing that you'll find is that 50% of the best days in the market happen during a bear market. So when you are least willing to want to be in the market, you see your portfolio going down a little bit, the emotions start kicking in. That's actually when 50% of the best days are. So we've already gone through why you shouldn't miss the best days in the market. And now what I'm telling you is that 50% of the best days happen during that bear market. So the reason we're discussing this is because it's really important to maintain perspective over a long period of time. Not to lose value of your long-term planning, your discipline, because of short-term movements in the market. Short-term movements will always happen. Look at this graph here. You look at the green line. Look at the amounts of ups and downs in the market. Every couple of years, you'll see downs, you'll see ups, but those who benefit the most are those who stay in it You stay the course. You have to stay the course. This one, instead of telling you missing 10 days, 15 days, it's just telling you if you missed 1% of the top trading days over this entire period from about 1990 to 2021, so about 30 years. Look at the difference in the returns you'd make if you stayed invested in the S&P TSX, which is the Canadian economy, versus missing 1% of the top days. It's massive. So this is something that's really important to make sure that you're keeping in mind during your investment and financial planning journey. Like I said before, right? It's always better to spend time in the market versus trying to time the market. And there's a specific reason why the average investor in the US and Canada tends to underperform virtually every asset class, because that emotion, that patience, that discipline is something that needs to be nurtured, coached, right? It needs to be focused on, and it needs to not be acted upon every time. So once again, if you look at this graph here, like I mentioned, every couple of years there's something. 9/11, the war in Iraq, the housing bubble burst, global financial crisis, Greek debt crisis, COVID crash, Brexit, right? There's, like I said, every day is just people buying and selling in the market. What you have to do is maintain that long-term perspective. Know that you're holding value in your portfolio. You're holding strong quality assets that you're willing to hold over the long run. Apart from that, it's just buying and selling on a daily basis. So it's important to stay invested in the market. Now, this is a great example. What this does is, we're going to go through a quick case study with you. So it's over a 20-year time period. There's 5 people. One is known as a perfect timer. One is known as a quick investor. One is known as a monthly investor. One is known as the absolutely worst timer. And one is known as a cash lover. Each of them get $2,000 at the beginning of every year. We're going to look at the period of 2003 to 2022. Now, the perfect timer invests as soon as they get that $2,000 every year. They invest that at the best time of the market. So let's say it's the lowest point of the market that year. Every year for those 20 years, they're investing at the lowest point perfectly of the market. They end the 2 decades with about $144,000 and $144,000-ish. Now, it's important to note that what they've done is impossible to do, right? No one, absolutely no one can do that. Move on to the next person, the quick investor. So they invest $2,000 as soon as they receive it. No matter where the market is, as soon as they get it, they're receiving it. So at the beginning of the year, they're investing the $2,000. The monthly investor is the one who's doing it on a monthly basis. They're taking that $2,000, splitting it up and averaging into the market, dollar cost averaging. The worst timer, the one who has the absolutely worst timing possible, is investing at the peak of every year. And then you have the cash lover who just sits in cash, money market, whatever it is. You can see the difference in all of them. Of course, cash, you're basically not growing, right? It's just sitting in cash. Over time, you're actually losing value to inflation unless the return that you're making in money market is above inflation. But if you look at investing it immediately wherever the market is versus perfect timing, the difference is not that much when you consider the fact that it's actually impossible to time the market perfectly. And then you compare it to dollar cost averaging and bad timing. Take the emotion out of it, and then you actually see how whichever of the 3 you do, you're not going to be too far off as long as you remain invested. Worst off is, of course, the one who stayed in cash. So I hope this scenario analysis kind of puts things a little bit more into into a more practical perspective for you to be able to understand what we spoke about up until now. Now, I think I've spoken enough, Irfan, so I'll pass it over to you to go over the macro outlook.
No, thank you very much, Zeeshan, and you have covered it beautifully. The idea of remaining invested is a paramount idea in the investing world, which we have seen in our careers. We spent our careers in the investing world, me and Zeeshan both. Just to guys, I know last 15 days, 20 days for pretty volatile in the market, global markets, and it was shaken in the start of August, especially, and that caused heartaches across the Atlantic, like in the investing world, professional and non-professional both. So what caused that was there was no structural change in our outlook from the middle of this year. So I just wanted to walk you through the global macro backdrop, basically. Essentially, this is a laundry list of some of the factors here. Some of them are long-term and some of them are pretty short-term. As Zeeshan briefly touched on carry trade, reverse carry trade, better from Japan. Japan is facing inflation. Inflation there had been pretty low, but recently inflation has reared up its head in Japan. And Bank of Japan was kind of like hinting at middle of July that they will raise the rates. So what the carry trade is that in the investors, professional investors and institutional investors, especially hedge funds, and they take out the money from the low interest rate environments, like in that currency, like in yen, and invest in high yielding currencies like Mexican peso or even US dollar for that time. This had been going on for almost 20 years. And because Japan had a lower interest rate environment for a very long time. And almost like it's estimated that around $15 trillion is in that trade. So what happened is that when Bank of Japan starts raising the rates, interest rates, that makes kind of that evaporates that profit in that trade. And that caused the margin calls. And margin calls is what triggered people to sell their equities wherever the profit was. And most of the profit was locked in the tech stocks. And that caused, that's why the tech was hit even disproportionately high compared to the broader market in this last month or so. How is that going to play out? I don't think that total reverse carry trade has completely evaporated. Market was calmed by Bank of Japan's governor's statement that, they are not considering to be very hawkish, and they are just monitoring yen to US dollar currency pair. So essentially, I think that eased the market a little bit. Second important issue, which was cited often by a lot of investment strategists, was soft landing versus hard landing debate in the US economy. There was a labor market report and there was retail sales report. Then there was a manufacturing report out of US, which painted a picture that US may be headed towards a hard landing. And that actually triggered, because when we started this year, we started the years with almost 6 rate cuts in 2024. That was the consensus at the start of this year. And it had been dialed back. It was dialed back by month of June of this year. It was dialed back to 1 rate cut of 25 basis points in 2024. Again, after this crisis and after some of the indicators, because Fed is data dependent, it was revised back upwards. Right now, the consensus is around 100 basis points in 2024. Although I think the latest numbers, which I saw yesterday and the day before that, Producers Price Index, as well as PCE Index, which is a personal consumption index, basically, that's one of the Fed's favorite. There, the core inflation was in line. It was not dropping more than expected. It was as per expectations. And then there was again some reversal of the odds that maybe there would not be 100 bips cuts in 2024. But regardless of that, inflation is coming down in the US, and the job market is being unwound as the lag impact of the interest rates. Generally, the full impact of the rate cuts is felt almost like maybe 6 months to the 18 months time after the first rate hike. So essentially, that's kind of like, our backstop is that if there's a weakness in the US economy as such, then that's countered by a more aggressive Fed rate cuts, actually, in which we have seen that being played out in the markets quite recently. And rate cuts are the discount rates on which the stock market's prices are kind of weighed on. And as the rates goes down, the valuations should go up, basically. So that's a backstop for any economic weakness in the US. So this crisis is not so far a structural crisis, basically. This crisis was not a structural crisis. And that was the reason, one of the reasons. Generally, we are, as portfolio managers, we are pretty proactive in looking at the global macroeconomic conditions and US macroeconomic conditions, Canadian macroeconomic conditions. And we try to be nimble at moving across this minefield sometimes. This scenario actually was more one of a reverse carry trade and margin calls, basically, which triggered it. There is still some money there in the reverse carry trade, and which can keep causing the volatility for the markets, including the US elections and US elections outlook, actually, in November this year, which will keep causing some volatility in the market. But there is no structural damage here. And the bear market, I know Zeeshan touched on the bear market and the best trading days being in the bear market, although I do not think we are in a bear market, and we will stay in a volatile equity trading environment here. Having said that, there are some other factors which are pretty positive. One is AI productivity boom, which is going to be a backbone of the GDP growth, especially in the EFI world and developed world, in the US and Europe, especially in Japan. And those countries are going to really benefit from this gain in productivity. Global outlook overall, China and emerging markets, they have not really underperformed the developed market for a very long time. Right now, they are priced at much higher discounts to the developed market as anything in the history. And there is a compelling contrarian argument for getting exposure to emerging markets. Chinese economic growth is being revised downwards. Numbers I saw last week, they were not that great numbers. Consumption, that's more not consumption driven, more like a production driven, because there is a glut of some overcapacity in some of the industries there, and also in the housing market in China as well. So there is some sort of a deflationary environment in China right now. But the Bank of China, People's Bank of China, is countering it by dropping the rates pretty aggressively and also pumping the money into the market, which is obviously really positive for higher valuation stocks generally, and equity markets generally, or asset markets overall, whenever there is a loose monetary policy, as we have observed a decade from 2018, and not decade, I would say, 2019 till I would say to 2022, 2023, and right during the COVID period. Some of the risks here, which looming risk for the portfolio, obviously deglobalization is one risk, which stints some of the very good companies which have an exposure to China, which sell to China. And there have been talk of tariffs and sanctions on some of the companies like ASML, for example. So that is selective, and we watch that pretty closely when we're tuning the portfolio, and we are aligning the portfolio according to our views on that front as well. I would go to the next slide, slide 20. This is the global GDP outlook, and this is from the Conference Board. And IMF and World Bank's predictions are pretty much in line with that as well. you would notice from that is that, it's not like in 24, 25 till 2035. There is a positive global environment, all 1.3% growth, global growth, all the mature economies, which include the US, Europe, and Japan, and Australia. Of that, US is by far a leading contributor to the developed economies. Overall, in the world, if you would say anywhere like during this same period, emerging market economies, China, Korea, they are outstripping. There's a second chart here, outstripping the developed economies quite a bit by actually almost 2 percentage points here, actually, roughly on average. So that's kind of like is not a situation where there's a recessionary environment, although there had been talk of a soft landing versus hard landing. And I think we are still not at that point, although we keep our watch on data that our economy is still, our projection on the global economy is still pretty substantially positive. We'll come to that later on, that some of the factors which are contributing to that later on. But I just move on to slide 21, which is just getting to where everyone's most interest is, that what's the implied earning for S&P 500 in 2024, and what's the forward price to earning ratios for in 2025. So essentially, I think from the start, we started this year at $220 per share for index 500 companies level, which has been revised upwards to 254, and still it's at that point. Actually, I think second quarter earnings, we have almost 90% of the earnings almost done, and of that, year-on-year earnings growth is around 11.5%, which is pretty good. Going forward, how is that going to look out? I think even going forward, there are substantial elements in place which will keep those earnings increase by, may not be at that 11-12%, but a segment like close to around 10% in 2025 as well. If we just use this as a simple mathematics back of the envelope, if we say that it's a forward price to earning ratio is in 2025 should be around 25 or 26, which is the consensus I saw from most of the investment strategists. That's basically essentially saying that there's a 15 to 20% upside to S&P 500 in 2025. I'm saying 2025 because we're almost at the fag end of 2024 already. And remaining part of 2024, we still expect at least 5 to 6% growth at the index level. So that's kind of like where I think our strategic positioning and strategic thoughts are. And I will revert it back to Zeeshan to speak more about the major elements of the GDP growth and AI, basically, which I hinted upon. And
thank you, Irfan. So, I mean, Irfan has covered the global macro outlook pretty well. You can see the GDP backdrop and how productivity is expected to boom, especially due to AI. Now, technology is something that could really help labor cost savings, and the expansion of PE, which is the price to earnings ratio of a company, not only has occurred, but could potentially continue to expand. And a lot of this is due to AI and implementation of technology. According to a research report by Goldman Sachs, AI could potentially automate almost 25% of labor tasks in advanced economies. Like Irfan mentioned previously, a lot of the AI impact and the boost to productivity would happen in countries that are developed economies like Japan, parts of Europe, US. And this increase in productivity could enhance long-term worldwide GDP by 15% over the long run. And a lot of this also depends on the adoption rate, which should increase over time because AI is not in its mature stage yet. It's in its growth, infancy slash developing stage, right? So the impacts of AI and the technology with it is still yet to be seen. Now, the increased economy-wide output because of AI in turn reflects on the company's earnings. Like Irfan mentioned, the forward-looking earnings of the S&P 500 and the companies within it, right? But it's unlikely to be fully priced in within the short term. So if you look at the chart on the right, this shows you the percentage impact of AI based on its adoption rate and its actual usage on a spectrum from a very, very powerful AI adoption and AI technology to something weaker. At the end of the day, it's still going to bear its impact on companies' earnings and their productivity in general, which should help the market over a long period of time. And then, Irfan, you want to add a little bit to
Yeah,
that?
I think in slide 25, I just wanted to kind of present you guys a graphical depiction of the total factor of productivity growth and its contribution to GDP. Because ultimately, at the end of the day, it's the GDP growth or overall economic growth which is contributing to the EPS growth of the stocks in which we invested. If you look at that 2008, the figure 2 here in this slide, there was some contribution to the total factor of productivity growth, which is basically green portion of this chart. There was none from 2011 till 2019 almost, and almost till 2024. Most of that growth came from labor quality contribution and the capital contribution. That has been a significant contributor to the growth. What is expected in 2025 till 2036, the last two columns of the figure 2, you would notice a very significant contribution coming from total factor of productivity growth, whereas the capital growth, the GDP growth coming from the capital contribution has come down a little bit, almost reverted back to historical level, almost 1.11 percentage points. So this is at the real growth, real GDP growth in the US, and it's not a nominal one. Basically, if you this is roughly, if you would think that a nominal, you would have to add the inflation, expected inflation, say we revert back to 2% point, and that's added up here as well. So in that environment, and on the left side, if you see that even if the trend growth is weakening in 25 to 30 and 31 to 34, still the contribution of total factor of productivity growth has really picked up in these two time periods. So essentially, I think that's going to be a sector we are watching very closely across the whole value chain. And its impact, it's not a single sector. It's not a tech sector. Tech used to be a very small portion of S&P 500 15 years ago, 20 years ago. Right now, it has become the most important sector, actually, biggest sector in the S&P 500. In the case of Sharia index, it's almost like, I think, 41% of the index. But all those components there are not really tech, but they are, some of them are derivative of techs, like impact of AI, adoption of AI, as Zeeshan hinted, on logistics, for example, adoption of AI on, say, Google, for example. So which one is the leaders here, adoption leaders? Then there's another part of the value chain is, because of this thing, there's a demand for data centers. There's a demand for chips and computing power. So obviously, there's a competition there, as we have to look at the whole SWOT analysis here and competitive landscape here, because but I can tell you, like some of those, like TSM, for example, Taiwan Semiconductors, That's opening manufacturing in the US. They've opened, I think, they're building 2 plants in Nevada. So that's another part of the foundry part of the value chain. So that's kind of hardcore AI, which is adding to that. But then there's also AI adoption, which increases the productivity of the all other sectors of economy, including even transport or logistics or industrial automation, Internet of the Things, IoT. So all those sectors we're watching pretty closely and how to position the portfolio to take the best advantage of this boom. Zeeshan, I would go give it to you give a brief on the suite of model portfolios, please.
Sure. So we'll end with just talking a little bit about our portfolio strategy, how we are positioned, and then we'll leave it to you all to ask any questions if you have any. Considering current market conditions, right? The benefit is it gives you a chance to reevaluate your portfolios, your journey, your investment scenarios. We offer different models based on our clients' expectations, clients' risk tolerance levels, where they are in life, and how it fits their financial plan. When it comes to these models, you can see how there's different allocations. Of course, the more aggressive you are, the more you're allocated towards equities. Now, why this is important is because if you find that during periods like this, you're actually finding your portfolio too volatile for yourself, it may be a good chance for you to reassess and reevaluate where you're at with your financial advisor and see if maybe you need to change where you're allocated, right? You may need to move from aggressive to growth or growth to moderate. But this gives you a chance to do that and kind of position yourself well going into the future in order for you to be able to manage your portfolio. Because remember, going back to what we spoke about before, which portfolio model and how you're allocated plays a huge, huge part in you being able to remain invested. So it's something very important that you need to consider and revisit in order to be able to make sure that you are actually able to meet your goals going into the future. Now, just before Irfan goes back into our portfolio strategy, one thing I want to mention with regards to earnings, as Irfan will also talk about, especially for US companies. When it comes to small caps, when interest rates decrease, small caps should technically benefit off of that. Now, one of the things that we are actually looking at and actively looking for opportunities are within the small cap space, because analysts are actually forecasting earnings growth of about 50% or more by the end of 2024 for small cap companies. Now, till now, they've been hit a bit harder due to higher sensitivity to higher interest rates. So a lot of opportunities tend to come up into the market, and we are actively looking for that. So one thing which Irfan will mention is we are trying to lower the beta of the portfolio as well, given current market conditions. But at the same time, if the opportunity does arise, we are looking at potential value out there within the small cap space, because we believe that when interest rates do drop and when they continue to drop, that should benefit that space quite a bit. And if you look at the chart on the left, right, you have the S&P 500, and then you also have the S&P 493, which is all the companies in the S&P 500 bar the Mag 7. So if you look at those companies, you can also see there where the earnings growth is expected to further enhance over the end of this year going into the next year. So it's just something that is important for you to kind of know, but at the same time, it just allows you to see how we're trying to position ourselves and how we're trying to plan for the near future in order to be able to manage the portfolios correctly, plus try and take advantage of all the opportunities that are potentially available to us. Irfan, you want to speak a little bit more about the
I just thank you very much, Zeeshan, and thank you very much for bringing in very good points here on the cap scale.
Yeah.
So there's kind of like that comes to the some of that is the strategic long-term positioning of the portfolio. and some of them are tactical, like as Zeeshan hinted upon, we had before and during this crisis, and even before this crisis, we were trying to lower the beta of the portfolio, especially because we thought that tactically, not strategically, market was over bought in middle of July. So we were purchasing some of the stocks, lower beta stocks during that time. One of example is Honeywell, which is a lower beta stock, relatively speaking. We increased our holdings in ExxonMobil. We got rid of some of the stocks which were basically higher beta stocks. So that was one conscious move during starting from July 15th. And that's not really predicated on like the drawdowns, basically. Drawdowns are the point at which portfolios they decline along with the market. Because of this positioning, reduced beta, our portfolios did perform. They fell less than the market overall market during the drawdown period, and then they gained pretty quickly during the updraft. So that's a beautiful place to be at, like when you have a lower drawdown and you have a higher up capture. You have a low down capture and a higher up capture. So even if that's different by 1 percentage points over the time, that really plays so well that it makes your portfolio really to outperform market by quite a significant margin. And I think we will keep doing that. Right now, the long-term strategy, and with that strategy that's at this moment, and that keeps changing as we keep having this discussion on that. We are neutral on U.S. equity. Obviously, U.S. equity has run ahead of most of the developed world. Europe and Japan, they are behind in the cycle, ahead in the cycle. The U.S. is slightly behind in there. Even Canada is ahead of the cycle, rate cutting cycle. So ex-US equity, we tend to be slightly overweight. And that also, interestingly, that over one of the positions through which we use develop ex-US equity in emerging markets is SPWO, is the ETF. We were trying to shuffle the positions from SPUS to SPWO to gain advantage. That's a strategic positioning again. Another angle is that inflation in developed world, although it has come down, but it's gonna be still may persist. My thought process is that it's gonna persist slightly higher than 2 percentage points. And commercial real estate is one of the places there which can take benefit of that, and especially during the falling rate environments as well. So that basically goes towards our positioning in the real estate sector and REITs ETF as well. And some of the thematic positions, obviously, we are always discussing that. They are renewable energy, obviously, IoT, digital currency, and blockchain, AI, automation, gene editing. We have exposures to these themes through different stocks. Those stocks have their up and down days. Some of those names we watch closely, and even these are not meant to be kind of, these are 5-6 years basically thought process, like looking ahead. And we believe in some of those themes and stocks representing those themes as well. Then on the emerging markets, basically consumption, we are positive on the emerging markets consumption. They're lower multiples. Their price to earning ratio is lowest of all the global equity markets overall. And also, I think a couple of standard deviations below their long-term historical average as well. So that's in the quant terms, that's almost like 70% probability, 65% probability that it will revert back from that level. That's a mean reverting level. And that's a strategic position is that, emerging markets and ex-US probably on a relative basis to the US equity will do better. But that doesn't mean to say that US market is going to not do well. US market is also going to do well. But because these names were lower in the valuations, and these countries they are ahead in the cycle. So I think that sets the stage for basically outperformance from emerging markets and ex-US equities. Basically, another angle is like there was a Goldman Sachs report on 2050 and 2075 global economies, and of the top 10 economies, 7 were currently in the emerging markets. And their market cap to GDP ratio is pretty low compared to the US. So it's a double whammy here. The GDP growth outstrips the US, and earnings growth obviously goes with that. And also market cap also expands, which expands the valuation. So that's a double whammy there in regards to that. Commodities, we have stayed in the material space, we have stayed overweight during this crisis. And in the last month or so, the materials are some of the best performing sector, I think, the best performing sector during this time. We have exposure to copper, lithium, nickel through different equities. Copper, we know that there's some seasonal moves, and there's a strike in Chile, which has affected the copper, and but that's basically plays on the flip side, that increases the copper prices and benefit. We don't have a holding in Glencore, but we have some in Southern Copper that benefits because of the copper prices increasing because of the strike and crunch on the supply. Technical positioning, obviously, yeah, again, I mentioned briefly on that, and we've watched the target prices. Some of the stocks which reach pretty close to target prices, we get rid of them. Some of the fundamental degradations like EV space, we look at that pretty closely. We were out of that stock for quite some time. We got in at a time when its stock was quite a bit down. EV space is becoming commoditized, and obviously, especially by China. And but again, there are some companies in China which can benefit from that, but they are exposed to the geopolitical risk and the sanctions there. There are some opportunistic trades we make. Some of them are momentum trades. Some of the risks here is basically Ukraine and Middle East. I touched on that briefly on the macro outlook. Middle East crisis where can ramp up if Iran and Israel crisis, Iran lobs missiles on Israel. That's obviously going to cause a bigger strife there in that area. So that's kind of like, what we'll look at. On the factorial side, I'll just be pretty brief. We are reaching at the end of our time. We think the quality and growth will command premium in a falling growth environment, and quality, and most of our stocks are very high quality, income statement quality as well as balance sheet quality. So that leads up to 2024 S2 market outlook, still positive, 6 to 7%. We think inflation probably is going to fall. Corporate capex is picking up. US economy can still avoid recession. And cooling of US dollars, yes, but that's kind of like on the relative basis because US is behind in the cycle in cutting. So that's not be an immediate concern that US dollar will lose out, because what we have seen recently, US dollar versus yen. When the yen weakens, then yen strengthens against the US dollar because of Bank of Japan's move. Then again, the parity there is established at somewhere around 105, 106 level, and brought the yen down against US dollar. Same as probably other developed currencies against euro, as well as British pound and Canadian US dollar. So that's roughly, I think, summarizes our thought process here. And I probably would open that for the questions here, unless Zeeshan wants to add something.
No, I think Irfan, you explained things pretty well, and I hope our viewers found this very beneficial. Especially during this time. I mean, you're welcome to put in your questions into the chat box, the Q&A box, and we'll be more than happy to answer them. I think if there's no questions, Irfan, it means we explained things pretty well.
Or we put people to sleep during this
Or we put them to sleep.
No, absolutely. Like if there's any questions, if not right now, I know some people would be hearing recordings later on. because not everyone is available at a certain time. So in that case, obviously, you are free to reach out to Zeeshan and myself through emails, or you can reach out to your financial advisors, and we'll definitely like to answer your questions.
Yeah. Our contact information is up on the screen, so if you want to make note of that, and then like Irfan said, feel free to send us an email and we'd be more than happy to help you. Whether it be to do with questions just to do with this webinar, the markets in general, or whether it's to do with your own financial planning, your own investment needs, any questions that you may have with regards to how you're going through that journey, how you plan for the future, and anything to do with that, feel free to reach out to either us, one of the financial advisors at the firm, and we'd be more than happy to help you. I don't see any questions here, so I think indeed people must have fallen asleep, or they actually did really get everything they wanted to out of this. So we will leave it at that. Thank you to everyone who did join us, and we'll speak to you soon, inshallah.
Inshallah. All right. Assalamu alaikum.